The first thing you check is the divorce date. TCJA flipped alimony starting in 2019. For agreements finalized in 2019 or later, alimony is not deductible by the payer and not taxable to the recipient. But pre-2019 agreements can be grandfathered, meaning the old rule still applies, deductible to the payer, taxable to the recipient. On the EA exam, they love hiding the year in the fact pattern. Even under the grandfathered rules, not every payment to an ex counts as alimony. To qualify, it has to be in cash, required by a divorce or separation instrument, and the instrument can't label it as something else like child support. The big trap. The payer must have no liability after the recipient spouse dies. If payments must continue after death, it fails alimony treatment. Also know what is specifically not alimony. Non-cash property transfers don't qualify. Letting an ex live in your house rent-free doesn't qualify. Community property income splits aren't alimony either. And if the divorce was finalized in 2019 or later, you can stop analyzing. Those payments are simply not alimony for federal purposes, even if the decree uses the word alimony. Child support is the easy bucket. It's never deductible by the payer and never taxable to the recipient. But the exam tests ordering rules. If the agreement requires both child support and alimony, and the payer makes only a partial payment, the IRS treats it as child support first until the child support obligation is fully satisfied. Only amounts above that are treated as alimony under grandfathered rules. Here's the sneaky rule: child contingency recharacterization. If a supposed alimony payment will drop when a child hits a milestone, like turning 18, graduating, marrying, or going to college, the amount tied to that reduction is treated as child support for tax purposes. It doesn't matter if the contingency is likely. The IRS treats that at-risk portion as child support, which kills the deduction and the recipient income for that portion. Property settlements are a different world. A transfer of property incident to divorce is generally not a taxable event. Think division of marital assets, not income. Retirement accounts are where people get burned. A QDRO, a qualified domestic relations order, lets a 401k transfer happen under the divorce without treating it like an early distribution to the original owner. On the EA exam, if you see a 401k split, look for QDRO language. One last exam favorite. Third-party payments can still be alimony under the old rules. If the decree requires you to pay your ex-spouse's expenses, payments to a hospital, landlord, or utility company can qualify as alimony because you're paying on behalf of the ex under the instrument. But you still need the core requirements, especially that the obligation ends at the recipient's death and the divorce is pre-2019 for deductibility. According to the IRS, which factor does not weigh in favor of the IRS approving equitable relief? The choices include abuse by the spouse or former spouse, poor mental or physical health when the return was signed or relief was requested, the taxpayer still living with the spouse, or none of the above. Think about which one is actually an unfavorable factor. The correct answer is the taxpayer still living with his or her spouse. Living together generally hurts an equitable relief request, so it does not weigh in favor of approval. Attempting wrong choice is abuse, because it sounds negative. But for equitable relief, abuse is actually a factor that supports granting relief. Elena and Martin divorced in 2017. Martin must pay Elena $22,000 of alimony per year in monthly installments. He must also pay her ongoing medical expenses. This year, the medical bills were $19,500. Martin paid $14,500 directly to the hospital and gave $5,000 to Elena after seeing the bill. How much alimony can Martin deduct this year? Think about it. The correct answer is $41,500 as an adjustment to income on Form 1040. The divorce is pre-2019, so the old alimony rules apply. The decree requires him to pay the medical expenses, so both the hospital payment and the cash paid to Elena are treated as alimony payments on her behalf. Attempting wrong answer is treating the hospital payment as a Schedule A, medical deduction, but it's not his medical expense.